Welcome back. So, in our last explainer, we talked all about a company's assets. Everything it owns. Today, we're going to flip that coin and look at the other side of the balance sheet, what a company owes and what that really means for what the owners are actually worth. Okay, let's dive right in. First up, just a quick thought experiment for you. If you had to sit down right now and make a list of everything you owe money on, what would you include? A mortgage, maybe a car loan, student debt, a credit card bill? Just keep that mental list handy for a moment.
Because believe it or not, a company's balance sheet creates that exact same list, just with a few more formal-sounding terms. It's really not as intimidating as it might seem. Let's start with what a company owes.
So let's get into that I owe you list. In the world of accounting, this has a very specific name, and it's absolutely critical for understanding a company's financial obligations and, its overall health.
And of course, that name is liabilities. Put simply, it's the sum of all a company's legal debts. We're talking about money owed to suppliers for raw materials, loans from a bank, payments to investors holding its bonds, or taxes that are due to the government. But here's the thing. Not all debts are created equal. The most important distinction a balance sheet makes is all about when that debt needs to be paid. Is it a bill that's due this month, or is it a loan that stretches out for years and years?
And this brings us to a really critical separation. We have current liabilities. These are debts that are due within 1 year, and they tell us a lot about a company's immediate financial pressures. Then we have long-term liabilities, which are obligations due much farther down the road. That 1-year mark is the key dividing line between short-term survival and long-term strategy.
So what kind of immediate pressures are we talking about here? Well, think of money owed to suppliers, which are often called creditors, or a bank overdraft, which is basically a short-term loan for when cash is tight. Interest payments and taxes that are due soon also fall right into this bucket. These are the bills that keep a CFO up at night.
On the other hand, long-term liabilities are really all about the future. These are the bigger, more strategic debts a company takes on to grow, like a 5-year bank loan to build a new factory, or maybe bonds issued to investors that won't be repaid for a decade or even more.
And hey, here's a quick note on the language. If you're looking at a British company's report, you'll see the term creditors. But in an American report, you'll find the exact same thing called accounts payable, or sometimes just payables. Same debt, totally different name.
Okay, so we've covered what a company owes. Now for the big question. Once all of those debts are accounted for, what's actually left over for the owners? What's the bottom line? That value is called shareholders' funds, and this number represents the net worth of the company. It answers a simple but really profound question. If the business sold everything it owned and paid off every single debt it had, how much money would be left for its owners? It's the owner's ultimate slice of the pie.
To really wrap your head around this, just imagine a company closes down. First, it sells off all its assets, factories, computers, everything. It collects all the money it's owed from customers. And with that big pile of cash, it pays off all of its liabilities to the banks, suppliers, everyone. The final amount of money left in the pot, that's what belongs to the shareholders.
So, where does this value, this shareholders fund, actually come from? Well, it's built from two pretty distinct sources over the entire life of the company.
So this value comes from two key places. The first one is share capital. That's the original money that shareholders put into the business to get it started. The second is retained earnings. Think of these as all the profits the company's made over the years that it chose to reinvest back into its own growth, instead of paying it out to owners as dividends. A young, growing company will have mostly share capital, while a really mature, profitable one will have a huge chunk of retained earnings.
And one more quick language check for you. In British English, it's called shareholders' funds, but in American English, you'll see the exact same thing referred to as shareholders' equity or sometimes owner's equity.
So this brings us to the crucial point, the one single equation that ties the entire balance sheet together, and it is this. Assets minus liabilities equals shareholders' funds. What you own minus what you owe equals your net worth. It's the fundamental formula of business finance, and it's just as true for a global corporation as it is for our own personal finances.
And that leaves us with a final thought to chew on. If you see a company with massive liabilities, but it also has very high shareholders' funds, what does that tell you? Is that a sign of a risky company that has borrowed way too much? Or is it a sign of a bold, growing company that is using debt as an opportunity to create even more value for its owners? Something to think about.